Tuesday, March 8th, 2022, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at whether the FT is going to be wrong again. About what? Well, they were wrong about gold in 2004, and they've come back in 2022 and called gold a fetish again. So we're going to reference one of Rafi Farber's great videos, and if you haven't yet, you should subscribe to Rafi Farber YouTube channel. And we're gonna reference one of my old favorites, the editorial from the FT from 2004, where they said that gold was finished, going gold. Before I start though, I'd like to say that we're also going to be looking at what gold did in the last one of the major geopolitical crises of the late 20th century, and that is the Iranian Revolution of 1979 and the hostage taking that the Iranians did, the American hostage taking in that same year. We're going to see what happened to gold then and compare it to what might happen to it today. So, yes, as I said, Rafi Farber did a really good video yesterday. It's entitled, "What is Money? Gold is Money. Show Me the Money." And he went through the latest hit piece that the FT wrote on gold from March 2nd, 2022. It's probably one that you need to do a screenshot of. I mean, I don't buy the paper FT anymore, and save it for posterity, just like I did with my editorial from 2004. And we're gonna come back to that in a minute. Yeah, Rafi Farber, he's been coming on my channel for over 2 years. I found him on Seeking Alpha and really liked what he wrote about. He's an Austrian School of Economics proponent, just like me. So we think very similarly. And I'm just going to summarize in a nutshell what this FT article from March 2nd said. And I highly recommend you watch Rafi's video as well. Basically, they said that gold is a fetish, right? And that money is a privilege. How come they don't know that money is the most marketable commodity? Well, because they haven't learned Austrian School of Economics, that money is the most marketable commodity. They haven't done the Austrian School regression theory analysis of money. And that means going back to the beginning of money to see what it really is. Money is just a step further from barter. That's what it is. There are some people that don't agree with that theory. But all money does, gold and silver, and they have been the most marketable commodities for thousands of years. It facilitates indirect exchange. That's what it does. So, yeah, the question is, the FT was wrong in 2004, and we're going to go through this again. I know I've gone through this a lot in the last 6 years, but many of you are new to the channel, and I think more than ever, this is very important. Just like some people are going to read, gold fetishism has had its day. Money isn't an asset, it's a privilege, according to the FT. This is March 2022. And gold was just around, just below 2,000 when they wrote that. And I was so, kind of incensed. And in April 2004, I had bought gold 2 years prior, and I was doing a lot of research and studying about gold, because once you get those first coins, you're really interested. And being a student, I I went deep into studying the Austrian school money. And when I saw this, and the story is that I was going to work into the city of London. I usually used to catch the 6:08 train from my station, and I used to buy the FT at the train station, and I used to turn to the editorial page. I used to like reading the editorials first, and this was there, going gold. The pointlessness of holding bullion continues to sink in. And this was from April 16th, 2004. And I even wrote, and I laminated it as well. The price on that day was $400.65. I don't know what time of the day I took the price. And I was working at MF Global at the time, or Men Financial as it was called. And I went down to the place where they did they used to do a lot of the binding for documents and stuff, and they had a machine to laminate it. So I asked the guy there to laminate this for me, so I wouldn't it wouldn't be damaged and I could keep it. So we're going to go through this again for those of you who are new. And yes, so at the time gold was at $400 or so an ounce. Now it's at 2,000. I'm sure a lot of people who hadn't really looked into gold back in 2004 would have read that and agreed. They would have said, oh, it's the Financial Times of London, they're right. And maybe they're kicking themselves right now with gold at 2,000. And maybe people are going to be kicking themselves not 18 years from now, but maybe a few months, and we're going to come into that when we look at the Iranian hostage crisis, the Iranian Revolution. So let's quickly go through this. The barbarous relic, as Keynes called it, is crumbling to dust when even the venerable N.M. Rothschild has quit the gold market and the Bank of France, among the most stubborn of the official gold bugs, is thinking again about its bullion holdings. The end of gold as an investment has come a little closer. And in this new hit piece on gold in 2022, they're criticizing Russia, of course, and all the countries that have been accumulating gold. So back then it was France. It will not be before time. The fetishization, there you go. They're still into this. They have a fetish about fetish, the FT, of shiny yellow metal decades after it ceased to be used as an anchor of the international monetary system, is a lingering anomaly in modern financial markets. Perhaps Rothschild's last service to the bullion market could be to keep a live gold trader on display behind a glass as a reminder of a bygone age, like the former coal miners who now make a living giving tours of defunct pits. Well, they might even have to open those again, the coal mines, with the energy situation. The one advantage of gold as a reserve asset is that, unlike assets based on fiat money, governments cannot make it worthless by inflating it away. But in an era of low inflation, there you go, and given the independent inflation targeting central banks are the norm across the industrialized world, that risk has very sharply diminished. Well, wrong about that, the inflation. Indeed, for both private and official investors, gold is now a rather risky asset with a nil or a low return. Well, at least doesn't have a negative yield, FT. The intrinsic value of gold, determined by its use in various industrial processes, is well below its market price. Gold does not grow, so, well, that's why it's money. So its value to any one investor as an asset is dependent on other investors also holding it as an investment asset. The gold price hangs precariously by its own bootstraps. Well, that was back at $400. For private investors to hold gold on this basis is their own foolish affair. For central banks and governments to hold it as a reserve asset is a betrayal of the public on whose behalf they're acting. Despite recent sell-offs, governments and central banks still hold about a fifth of the world's bullion. Their large holdings relative to the size of the market by themselves make gold particularly ineffective as a reserve asset. The very acts of official selling of bullion on any large scale to raise cash will itself drive down the price. The danger was amply demonstrated by the UK's unhappy experience of trying to sell some of its gold holdings. Well, they pre-announced it. That's why it went down. They were stupid enough to pre-announce it. Gordon Brown announced in 1999 in a sensibly open, it wasn't sensibly open, and transparent fashion. The sales sparked such a fall in the global bullion price that a group of central banks signed a concord limiting such sales. That has recently been superseded by a new agreement providing for limited official sales. I don't think there's going to be any sales right now, especially with the power to sanction and basically stop central banks from operating. So there we go. Given the pointlessness of holding gold, the speed of its official sell-off scarcely matters. Well, 18 years later, it hasn't come off, has it, FT? Unless leaching the gold into the market bit by bit somehow maximizes the return to the public purse by limiting the impact on the price. That would imply some irrationality on the part of the market, but then holding gold is irrational in the first place. Perhaps the central banks are right to go slowly. Whatever the speed, the direction is clear. Gold is on its way out as an investment and reserve asset. 3 cheers for that. So why are the FT so anti-gold? Well, because gold is the money of the free market, the money of small government, sound money, honest money. And so is silver, of course. I would add silver to that as well. And the FT is an uber globalist institution financed by the bankers who are in charge, who dread to lose their power, to use debt as money, because that's what we have right now, fiat currency. So we're going to look at the price of gold, what happened to gold in 1979. And most people think that the whole of the 70s was a great time for gold. And generally speaking, it was. Gold was at $35 an ounce in 1971 and finished, January 1980, it reached almost 900. I think the high was 887.5. How do I know that number? Well, Jim Sinclair always used to talk about that high, 887.50. But there were lots of up and downs. There were periods where gold didn't do anything. But then came the Iranian Revolution in 1979, which I remember really well. I was about 14, 15 at the time. I didn't really follow markets at all or gold like I do today, but I remember the Iranian Revolution very well. And it started, when did it start? Well, it started January 1978 and it lasted until February 1979. But even more important was the Iranian hostage crisis. The Iranians, they invaded the U.S. embassy and they took 52 diplomats and citizens. They were held hostage until January 20th, 1981, when Reagan was inaugurated. There's a little bit of a backstory to that, but we're not going to focus on that. So, and why am I looking at this? Well, because right now we have a geopolitical crisis that, in my opinion, seems to be a lot bigger than this. Russia, Ukraine, NATO. And am I saying gold is going to do what gold did in 1979? It's going to do that in 2022? No, because I think things are different in 2022. In 1979, we didn't have a stock market bubble. We didn't have a bond bubble. We didn't have the huge amount of debt in the world. Yes, we had rising prices, rising cost of living. But yeah, things are quite different, and it might take longer for the bull market in commodities and gold to continue. But I'll show you what happened. So the market really started picking up here, as you can see, in around April 1979. We're still below $250, and then it started picking up, and it went to like 400. I think, let's see when that was. In October of 1979, that was the all-time high there, 428 at the time. And then it dipped below 400 again in the beginning of November. And then from then on, it went almost straight up in a straight line. The chart here says 850, but we really went up to like 887.50 on an intraday basis. So you can see that in basically less than a year, gold went from 250 to 850. So it went up 3.5 times. And if you weren't invested, if you hadn't been investing or accumulating gold throughout the 70s, you probably wouldn't have jumped on the bandwagon there. And then, of course, we came off after the 80s. But as I said, I think the situation is completely different. And that's why I wanted to show you this, because a lot can happen now. There's a lot of people probably who were concerned. Someone sent me a message saying, oh, Jim Rickards is selling his Barrick Gold shares because he thinks it's going to come down. I'm holding on to my Barrick and Newmont, some of the ones that I have. Aside from being in the beginning, I think, of a major move, the miners, I think we're just starting. The second leg here of the bull market in gold and silver, and it's more of a bear market in currencies. And I think the situation is very different, but it just goes to show you how a crisis can really trigger things. Am I saying gold is going to go up 3.5 times in the next 12 months, just like it did during the Iranian Revolution hostage crisis? No, it could be less, a lot less, but I think it has longer to go in terms of time frame. I think that was, of course, a major spike there because of the Iranian Revolution. We also had the silver squeeze. So with that, let's quickly look at where the markets are this morning. So it's 8:15 a.m. London time. So yeah, gold this morning or overnight has decisively broken above 2,000. Am I excited? No, I try to be even keel no matter what, no matter if we're smacked down to 1680 or, yes, you need to like be balanced and know that you're not here to make fiat profits. You're here to safeguard what you've been able to save throughout your working life, be it very short working life or a very long working life, because I think that's the kind of environment we're in. Anyway, right now, yeah, we're at 2007, gold up $9. The high's been 2021 and the low has been 1980. Silver, yeah, silver has been above 26 overnight. I think it was above 26 when I was preparing for this report. The high was 26.33. Right now we're at 25.90, up about 23 cents. So very volatile. You should expect volatility. You should expect when the US markets come in early in the morning that they will smack gold and silver as they usually do. But I wouldn't be concerned. What about the stock market? Stock market having a very tough time. I noticed the NASDAQ is down, I think, let's see, 18% year to date. S&P is down almost 12% year to date. So not looking good for the stock market this morning. The Dow is down 60 at the moment. The NASDAQ is down 50 and the S&P is down 5. And I think we've been down a lot more. We've been down over 400 points in the Dow. So things have rebounded here a little bit. The FTSE is down 39 at 69.30. The Euro stocks are up 20 and the DAX is up 10 points. To the currencies, yes, the dollar has been strong of late versus the fiat currencies, but the dollar actually is falling sharply versus real money, not fetish like the FT says. So sterling is up 0.2 at 131.22. The euro is up 0.5%, 109.02. The dollar is up 0.1 versus the yen at 115.40. The dollar is down 1/8 versus the yuan at 631.74. Aussie dollar is down 0.4 at 72.87, and the dollar is unchanged versus the Canadian dollar, 128.09. Kiwi dollar is unchanged at 68.28. Commodities are going crazy, of course. We've looked at them the last few days or trading days. Yesterday, I think nickel went up over 60%. We've seen wheat and corn go limit up. So things are getting really wild. So right now we've got WTI crude up 1% at 118.38. Brent is up 1.2 at 123. High grade copper is up 1.8% at 481. And yes, natural gas as well yesterday. European natural gas, I showed it to you, went up like 50% or something even crazy, just as crazy as nickel. Yes, and these commodity prices might come down, but they're also very volatile. We're seeing huge swings in prices. We saw lumber, of course, in the last year and a half or so, make huge moves. And that's not good either, the sharp volatility. That means that the currency that these commodities are denominated in is losing its stability. It's not the commodity. And this is another sign of what I spoke about yesterday, the crack up boom, the loss of confidence in the currency. And it makes it really hard for consumers, producers, manufacturers to really measure or forecast forward. And that's not good. That means more shortages, higher prices. To finish off, let's look at where the bond market is. Yeah, I've noticed, that yields are actually going back up, which isn't a great thing, especially with the stock market going down. The 10-year yield is up 9 basis points this morning at 184. The 2-year is up 5 at 160. So you would have thought with the massive move lower in the stock markets yesterday that yields would have gone down, but no, they went up. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.